economically, but we understand that. We understand that very well.
Edward Lawrence with Fox Business. Thank you for taking the question, Chair Powell. So I want to go back to jobs and the consumer. The last jobs report showed that over the past year, 634,000 more people took multiple jobs. That's up 8.2%. And since January of 2021, we've seen prices rise 19%. So people are using their credit cards to pay for their lifestyle. What pressure points will signal to you that the slowing economy could maybe break companies in terms of hiring or break the consumer in terms of spending?
So, we monitor all the things you mentioned and more. What we're seeing is basically spending was going up faster than disposable income during big parts of last year rather. And so what you'd expect to see is people spending more on their credit cards. That has been happening. Credit card balances have been going up. Credit card defaults have been going up. They're not at high levels. Remember that after the pandemic, people were cooped up. They couldn't spend money. They couldn't go out to spend money. They could spend money from home. But households were in very, very strong, historically strong financial shape. They've now worked off a lot of that. So we're watching that carefully. And, what do we see? That's what we see. We see the same data that everybody else sees, but you've still got household sector that's in pretty good shape. But nonetheless, it's not in the kind of shape it was in a year or two ago. And we're carefully watching that.
So how close then are we to that point where the consumer can't continue to spend as it's spending, or companies can't hire like they're hiring?
Consumer spending is still growing. It's not growing at the pace it was growing at a year or so ago, but it's still growing solidly. And by the way, other parts of the economy are picking up. Spending on equipment and intangibles has picked up quite a bit in the wake of all the construction that we saw of new tech plants. So overall, the economy is exhibiting solid growth, and something around 2%, which is a good pace of growth for the U.S. economy. But you're right though. We do see the same thing other people see, which is increasing financial pressures on more lower income people, and the best thing we can do is to foster a very strong jobs economy, which we think we have done. Ultimately, to get inflation under control, because those people experience inflation, very directly, very painfully, and once we get inflation under control, rates can come down, which will also improve things.
Victoria. Hi, Victoria Guida with Politico. You've mentioned that an unexpected weakening in the labor market would bring rate cuts sooner, and I was just wondering, can you talk a little bit about what that would look like? Is it more of like a quicker pace of people losing jobs? Is it more the level of the unemployment rate if it were to start to go above 4.2 or something like that? How are you thinking about what you're looking for to see the job market unexpectedly weaken?
When I say unexpectedly, the first thing is more than kind of is in our forecast or in common forecasts. So something more than that. But we'll be looking at everything. The labor market, has the ability, has the tendency sometimes to move and to weaken quickly. So waiting for that to happen is not what we're doing. We're watching very carefully. We're looking at the balance of risks. I always point out the balance of risks. So and also the fact that we look at all of the whole situation. So a decision to begin to loosen policy could have several reasons associated with it at a given time. But I would just tell we monitor all the labor market data, and if we saw troubling weakening more than expected, then that would be something we'd consider responding to. But we look at the broader context of what's going on too.
So something like negative payroll numbers would be.
I'm not going to. I mean, I can think of things many things would make it on that list, but I don't think I'll utter them here.
Thank you, Chair Powell. Simon Rabinovich with The Economist. May I ask, you mentioned with the slightly higher PC readings earlier this year that it wasn't 1 or 2 months, but 3 months that tipped you to be a bit more cautious in the rate outlook. Should we take from that it looks like May will be quite good for PC as it was for CPI? Does that imply that kind of 2 more good months would reinstill the confidence that rate cuts could be coming sooner than you currently project?
You know, I don't actually have that kind of mechanical thing in my thinking. I get that, you know, as many good ones as we had bad ones, but no, it's not like that. It's the whole, it's going to be the totality of the data. The labor market data, the growth data, in terms of inflation, you know, you'd want to see real progress that builds your confidence that we are on a path down to 2%. And I don't want to try to give you specific numbers of things, and because that points to dates, and I just don't think we're not at a point of being able to do that.
Thank you for doing this. I'm Kosuke Takami with Nikkei. I would like to know about the impact of stronger dollar on U.S. economic growth and prices. And I have no doubt that the market should determine the exchange rate, but Japan and some emerging markets are suffering from the strong dollar. So I want to know if it is having a positive impact on U.S. economy in total. Thank you.
So we don't, actually it's our finance ministry, the Treasury Department, that has a responsibility for thinking about and if it sees fit, doing things about the level of the dollar. So for us, it's just another financial variable. And you're right, the dollar has been, has exhibited some strength over the course of the last year or so because the U.S. economy is very strong. We don't think of it as benefiting or hurting the U.S. We don't manage the level of the dollar. That's not our job. It's not, you know, and for our economy, what we're trying to foster is maximum employment and price stability, and we feel like we've made good progress on both of those goals over the course of the past year.
Jennifer. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you would cut rates before inflation falls to 2%. You're forecasting inflation to end the year at 2.8% on core PCE, or at 2.8%, of course, on core PCE. Right now, you said the inflation forecast is conservative and that if you got 2.6 to 2.7 on PCE, that would be a good place to be. You also indicated the job market has mostly normalized. So why not cut rates this summer just once? You're well above neutral, to try to preserve the soft landing rather than risking waiting too long in the quest for confidence for inflation.
You know, so we're well aware of the two-sided risks here. Let me just say, we understand that if we wait too long, that could come at the cost of economic activity, of employment, of the expansion. We understand that if we move too quickly, we could end up undoing a lot of the good that we've done and have to then start over, and it could be very disruptive. So we're extremely aware of both of those risks and just basically trying to manage them. And what we said is that we don't think it'll be appropriate to begin to loosen policy until we're more confident that inflation is moving down to 2% over time on a sustainable basis. That's kind of been our test. Or there's another test, which is, you know, an unexpected deterioration in labor market conditions. So I think that's the right way for us to think about it. That's our dual mandate there, and you know, we have a strong economy. We've got growth. All forecasts are very commonly around 2%. That's a strong growth rate for our economy. The labor market continues to print jobs at a pretty high rate. Unemployment's still low, so we have the ability now to approach this question carefully, and that's what we're doing.
Just to follow Chair Powell, do you need to be ahead of a weakening in the labor market? Otherwise, is it too late, given that the labor market is a lagging indicator, right, when you look at the monthly jobs data?
Yeah, we completely understand that that's the risk, and that's not our plan, is to wait for things to break and then try to fix them. We're trying to balance these two goals in a way that is consistent with our framework, and we think we're doing that.
Thank you, Chair Powell. Evan Reiser with Market News International. You have mentioned before the framework review process will start in the latter half of the year. At this point, do you have any specific time frame for the start of that? Who will lead it? Will it be you or a committee group of your peers? What will be the parameters? Do you anticipate the review will consider changes to communications going forward?
So what we've been thinking is that we would announce and commence the review later or late in the year. In the meantime, as that time approaches, we will be devoting a lot of careful thought and planning to the contours of it. Within scope would certainly be communications generally. I'm not going to say that we'll look at this or that particular thing, and all the other details. We don't want to get prematurely into a conversation until it's really time to have it. And so, I'm going to leave pretty much everything else to later in the year.
Go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just one more question on housing. Can you still cut rates with shelter prices high, or will you wait until they start to moderate a bit?
I wouldn't, there isn't any one thing, one variable like housing prices moderating that would really decide against what we're doing. We've got an overall test, which is greater confidence that inflation is moving down to 2% on a sustainable basis. That's our overall test. Or alternatively, we see unexpected weakening in the labor market. So those are two different tests. I would say, we're not looking at any one price in any one sector and saying that's the one. We don't target housing prices, for example, and we don't target wages. We target aggregate prices and overall employment. So,
But if housing prices remain sticky, could that slow down the pace of rate cuts?
I think you'd look at we'd be looking at the aggregate numbers and asking ourselves what's going on here with inflation at the aggregate level. And of course, if any price that contributed to ongoing inflation would matter. Any price that contributed to ongoing disinflation would matter too. But I wouldn't single out housing as having a special role there. Thank you very much.